In part 9, we talked about what the stock market actually is: a marketplace where you can buy small ownership stakes in real businesses. But what exactly is that ownership stake? It is called a share. Let me explain what that actually means. Say a company is worth 100 rupees. The owners decide to divide that company into 100 equal pieces. Each piece is worth 1 rupees. Each piece is 1 share. Now they offer those shares to the public. You buy 10 shares. You now own 10% of that company. Not 10% of the building, not 10% of the furniture, 10% of everything the company owns, everything it earns, everything it will ever be worth. Now here's why companies do this. When a company wants to grow, it needs money. It could borrow from a bank, but borrowing means paying interest every single month. Or it could sell shares to the public, get the money it needs, without borrowing, without paying interest. In return, the people who buy shares become part owners. That is the deal. You give the company money to grow, the company gives you ownership. When the company grows and becomes more valuable, your shares become more valuable too. If you bought 10 shares at $1 each, and the company grows and each share is now worth 5 rupees, your 10 rupee investment is now worth 50 rupees. You did not do any work. You just owned a piece of a business that did. That is what a share is. That is what it means to own one. In part 11, I will show you what Sensex and Nifty actually are, and what those numbers on the news actually mean.